Hello and welcome. This is the very first lecture on my YouTube channel. We'll be discussing the Calub's model. There are variants to this model, but this is the simplest one. Now here, what you're seeing is a line chart or the skeleton of price. How price moves from lows to highs, highs to lows, creating higher highs and higher lows, and lower highs. Now, basically, below old lows rests sell side liquidity. Now, everybody that was with price when price was going up will have their stop loss placed below old lows, and everybody following price down will have their stop loss placed above old highs. Now, want to see price run below that's old low or sell side liquidity, so that traders who were looking to go short upon breakout will have their sell stops triggered. Also, traders that have been long have their stop loss here, will have their sell stops triggered. And then we'll wait for price to show willingness or create an opportunity. In this case, this was an inverse fair value gap, to show willingness that it wants to go higher above old highs. We had a short-term high above here, and then create opportunities or entries for us to enter and go above higher. And this is a inverse fair value gap, and this is a fair value gap, and we'll look at it in a candlestick chart. Now, this is a candlestick chart. This is that low sell side liquidity, and this is the high buy side liquidity. We have liquidity resting below and above those highs and lows. Now we want price to run below it, which it did, triggering the sell stops here, and then everybody that was with it while it was going short will have the stop loss placed above that old high, and then we'll look for an opportunity to go back. In this case, the run below the sell side liquidity, that first fair value gap here that you're seeing, we want to see price come back to it after shift in market structure. That will be our entry, first entry. Where will our stop loss be? Our stop loss will be there or at that low, and then our take profit can be here or there. Now we have another long-term high, which I'll show you later on. So price comes back into it, comes back into it again, comes back into it again. It creates another chance of fair value gap here for us to enter, comes back into it. There is a run above that old high, and then to the short-term high that we marked out. And then also price kept going higher, but we couldn't get to that point, that long-term high. And then price came back down. Everybody that was with price while price was going higher will keep adjusting their stop loss from there to here, here, stop loss here, and then price will run below, triggering that stop loss. These are relative equal highs, sell side liquidity. Price wicked it and getting an opportunity after this shift in market structure, a willingness to go for this buy side liquidity and that long-term high there. Market dipped into that fair value gap, and we want to see the price stay above the midpoint of that fair value gap. So it kept going higher, engaging this buy side liquidity, and eventually that long-term high. Now this will be our first entry, and our stop loss will be, this will be our first entry, and our stop loss will be there or below that low, targeting this and that. We can take partial midpoint from this to that. We can take partial that line and then push our stop loss to break even or above that high. This is the second entry, fair value gap. Price came back into the gap. This is that BC, buy side imbalance, sell side inefficiency, and then rallied to that short-term high, buy side liquidity, but we couldn't get to that point. Now this was a run for everybody that adjusted their stop loss following price. Have the stop loss right there, right there. It was a run. Below it, market gave an entry, an opportunity to go higher. So that's it, and we'll talk more about it in the Discord. Thanks for watching. Bye for now.